Hi, everyone. Welcome to Home Buying Tips with Allie. This is our first show, and forgive my voice. I'm a little bit under the weather today. So with me, I have Eric Dahlberg of Gold Standard Mortgage. The reason why we're putting on this show is because many of you have heard about first-time home buyer seminars. Many of you have been invited to them. Many of you have attended them. And there's a lot of valuable information that comes from those, but we also have some first-time home buying myths that Eric wants to discuss with us. So Eric, welcome to the show.
Well, thank you, Allie.
You're welcome.
Hey, everybody out there. My name's Eric Dahlberg. I'm with Gold Standard Mortgage. And we definitely want to just dispel any myths people have about buying a home. We'll go over a lot. There's quite a few of them. And we just want you guys to understand what the truth is versus the myths.
So, Eric, how long have you been a loan officer?
I've been a loan officer for a little over 6 years. Started with Chase Bank, and now I'm with Gold Standard Mortgage.
Awesome. So, where are you based out of?
My office is in Visalia, but we have offices. We have an office in Hanford, and Kingsburg, and Fresno, and Visalia. So Gold Standard Mortgage is here to serve the Central Valley.
That's wonderful. And are there a lot of different loan programs out there that you can offer to your clients?
We have a lot of loan programs, and the beautiful thing about Gold Standard Mortgage is that we're a broker, so we have all kinds of lending programs, whether you want commercial property, or maybe you need a hard money loan because you want to flip a property, or maybe you want to buy a piece of land and build a house on, or maybe you need help with down payment assistance. We have a lot we can help you with.
Wonderful. Okay, well, we'll be back in a few moments, and we're going to get into some home buying myths with Eric. We'll be right back. So welcome back to Home Buying Tips with Allie. I'm here with Eric Dahlberg of Gold Standard Mortgage. And I'm sure, Eric, with all your years of experience, I'm sure you've heard a lot of myths that your clients have been told by other people. We always hear, someone told me this. And so some of the myths you wanted to discuss today, we're going to be discussing on this show.
Okay.
One of the biggest myths is, where does a client's credit score need to be in order to purchase a home?
Well, just so you guys know, you don't need an 800 FICO score to buy a house. Actually, credit scores will vary depending on the program and what kind of assistance you need. If you have money to put down yourself, like 10%, as long as you have a 500 FICO score or higher, you can get an FHA loan. And in one program. And then if you need down payment assistance, it's a 640. So it's going to depend. The old saying goes, money talks. Well, the more money you have to put down, the less likely your credit situations will hurt you. There's a lot of programs out there that won't take into account any foreclosures or short sales or bankruptcy if you're putting 15% down. So it really just depends. But the main thing is it comes down to is, what do you need? If you need money for down payment, then you have to have a 640.
So what about collections? A lot of people have unpaid collections on their credit report. They have charge-offs, late payments. How much does that affect their buying power to purchase a home?
You know, I get that a lot where I'll talk to someone, they go, well, I want to pay off all my collections before I apply for a loan. And what they think they're not going to qualify, but you know what? They might actually qualify with some collections on your credit report, because even though it hurts your score, as long as your score is high enough, then we can qualify you. The other thing that we have to account for collections is we have to plug in a payment. So guidelines say 5% of the gross collections amount. We have to plug in a monthly payment for that, or if it's student loans, it's 1% or even 0.5%, depending on the program. But even if you're not paying your student loans, people, we have to put a payment in. So even though I get this a lot, well, my student loans are in deferment. Why are you putting a payment there? I'm not making any payments on it. Well, thing about student loans is you can never get rid of them. You can't even file bankruptcy. So we do have to put in a payment for student loans, whether you are paying them or not. We will use, if you're making payments, of course, we'll use the payments on the credit report. But if there is no payment and you're deferring it, you have to plug in a payment. So student loans can hurt just as much as a collection could, depending on how much that payment is and how much collections you have.
Right, because eventually you do have to pay back those student loans.
Exactly. And in collections, there's a certain time period that they will keep collecting for. You know, and you're more the expert on that. What is the time period on collections?
Yeah, so any collection that's older than today's date, 2015 and older, in the state of California, in the state of Texas, because they also have a 4-year statute of limitations, is no longer legally collectible by law. So it's not 4 years from the date you went into collections, but it's 4 years from the date you last made a physical payment to the debt collector or to the original creditor. So it's very important to know those dates so you're not just, like I call it, gifting away your down payment money. Excuse me, my voice. Gifting away your down payment money that you could actually be saving in order to purchase your home. But we could help you out with those items. So Eric, we're going to take a quick break. When we come back, we're going to discuss that lovely Credit Karma and what you as a loan officer find when people are trying to compare their Credit Karma scores to their mortgage scores. And we'll go more into depth about that. We'll be back soon. Thank you. Hi, everyone. Welcome back with Home Buying Tips with Allie. I'm here with Eric Dahlberg of Gold Standard Mortgage, and we're discussing home buying myths. So one of the myths out there is Credit Karma. Everyone has that lovely app on their phone, and they think that that's their credit score. But Eric, in your experience, what have you found or what have you seen with clients' Credit Karmas compared to the reports that you're physically pulling?
Well, Credit Karma doesn't use your standard FICO model. It's Vantage Score 7, and it's way off. It could be, it's all over the place. I've seen it higher, I've seen it lower, I've seen it actually sometimes within a few points. It is very unreliable. It's hard to tell. When someone says, well, Credit Karma told me I had a 750, then I'm like, well, they're probably a 680, maybe 670, in my mind. Because we use an older FICO model. It's an older algorithm. There's actually more than 50 different versions of the FICO score. So we use the oldest ones. If they're more conservative, they're gonna hit your credit a little differently when it comes to how much usage you have, your lates, all that kind of stuff, because you're borrowing money for 30 years. So it's not like you're buying a car that the 5-year car payment's going to be up in 5 years. You're buying a home for 30 years. You're paying a mortgage. You're obligating a mortgage for 30 years. And whether you have that mortgage for 30 years is a whole different situation. But the bank has to look at it like, look, this person's going to pay us back for 30 years. We better make sure they have really good credit. So the credit scores that I'm going to pull are going to be lower than the credit score the car dealership pulled.
Correct.
I have people go, well, how come you can't approve me for a home, but I got approved for a $50,000 car with the $800 car payment? And I'm like, well, they don't care if you don't, they just want to sell the car. I'm sorry, they're not as regulated as mortgages, so their credit scores are a lot more looser than ours are.
So let me reel that in a little bit. So Credit Karma is based on a Vantage Score 3.0. It's not even a FICO score. Credit Karma is a great tool for you to see if you have any new collections, any new charge-offs, any new accounts. Updated balances. And also Credit Karma does update you every 7 days, whereas your credit scores or your creditors, they actually pay to report your credit 2 to 3 credit bureaus every 30 to 90 days. So imagine that your scores are your credit's really being updated every 30 to 90 days to the 3 major credit bureaus, but Credit Karma is updating you every 7. So how accurate is that score? Also, as Eric mentioned, there are 50 different FICO algorithms out there. So your score this is my score according to whom? You have the CreditWise from Capital One, that's your score according to them. You have the Discover app, that's your score according to them. If you're going to purchase solar, they're using a different algorithm, so that's your score according to them. So that's the key this is my score according to whom. So don't ever be fixated on, I have an 850 credit score. You do according to whom. So that's the main goal and the main focus out there. Now, when it comes to purchasing a home, your mortgage loan officer, as Eric said, is using an older model, which is FICO 2, 4, and 5. On average, if you deduct about 45 points from your Credit Karma score, that's about where you're going to be. Now, there are some instances where maybe you've always made your car payments on time, have excellent car buying history, and your Credit Karma scores could actually be lower than your FICO 2, 4, and 5 to purchase a home. We've seen the flip side as well. So it's very important not to get stuck on this is where my scores are, because this is what my scores are according to whom. So I hope that's a better explanation out there for everyone watching.
Yeah, and for those people who are really sensitive to their score, they're afraid that if I pull your credit, that you're going to knock a bunch of points off your credit score. That's not true. It's about 5 to 7 points, but I also offer a soft pull that we can look at their credit score without dinging their credit. Now, what I have to tell my clients is, look, we're doing the soft score at first, just to get an idea where you're at. When you get into contract, that you're actually buying the house, I'm going to pull your credit, so it's going to drop 7 points. So don't freak out on me. Don't call me up and be mad. That's just because I had to do that. I actually have to get a real credit report. But I have that service where I can offer a soft pull for people out there who are worried about, maybe they're on the borderline of qualifying for down payment assistance, and they're afraid if I pull it, it's going to drop them below. It's still going to happen, though. So we do have some work to work on there. We have to see if we can get your score up 10 points. But that is the service. If you're interested in applying and you're worried about your credit, let me know. I can pull a soft pull for you.
Yeah, and that's a great tool because they can see, now mind you, I believe your soft pull is only based on TransUnion. It's not based on all three reports, but it still gives them a way to see how many collections do you possibly have on there. How many accounts do you have? Where's your debt to income ratio? And of course, it's not going to be a solid number because they need to be able to see all three bureaus, not just one. But it's still a great tool to at least give you some insight if you want to move forward with the process or not.
Yep.
So, yeah. Okay, so when we come back, we're going to be discussing how much down payment do you really need to purchase a home. So stay tuned and we'll be back shortly. Hi, everyone. Thank you, and welcome back to Home Buying Tips with Allie. I'm here with Eric Dahlberg of Gold Standard Mortgage. So before we go into what down payment is actually needed, I'd like to ask you, Eric, sometimes clients want to go rate shopping, and they start going from lender to lender to lender. How does that work, and how much does that affect their credit scores?
It doesn't affect the credit score as long as it's done within 30 days, so that's fine. I talk to a lot of people, and they go, well, I'm already pre-approved at such and such, and they're getting a certain interest rate, and I can get them a much better deal, but they're afraid to even apply with me because now they'll have to run their credit again. And that's when I have to explain to them that they're going to allow you to freeze your credit as long as you are getting approved for a mortgage. If you go car shopping, then jewelry, that's something else. But as long as you stay within the same industry, so you go from more lender to lender, they want you to shop. It's in your best interest to shop. And you should shop. You should shop. I encourage my clients to shop me. Please shop me. Because you know what? If you can get a better rate, then I'll go back to the owner and say, hey, I need to, let's see if we can do a better rate for our clients. So I want you guys to shop. But one thing I will say, though, is if you're getting down payment assistance, there is no point in shopping because they're the same rates for everybody. The programs are designed that way. They're designed for whether you have a 640 or an 840. Everybody is getting the same interest rate because it is a government-backed company or an entity that is doing it. And so they're a part of the state of California, so they don't want to discriminate against anybody for any reason. So with down payment assistance, you're going to get the same rate whether you have, which doesn't matter what your credit score is. Now, if you're putting money down like a standard FHA loan or conventional, I recommend you to shop and see if you can get a better rate for yourself.
So what does what does affect the rates? Is it what the loan officers are charging? Is it the interest rate? What is it that the clients need to be shopping for?
That's a good question. Actually, a lot. That's all the above. Okay. What's going to affect your interest rate? Well, one is first off is your credit score. Okay, so that'll affect it. Obviously, the higher, the better. Okay. The amount of money you're borrowing affects your credit score. People who borrow, and I explained this to them, like let's say you're buying a $150,000 house and your loan's only like $140,000. Your interest rate cost will be higher than someone who's buying a $300,000 loan because of loan level pricing adjustments. Basically, the bank is encouraging people to borrow more. They're like, well, if you borrow more, I'll give you a better break on this rate. Instead of the 4% costing you 1%, it only costs you 0.5%. So the more money you borrow, the better break you get on your rate. So the amount of money you borrow, as well as the compensation, depends on what the company needs to make. That's called we call it padding the rate. That's what they need to make for their own expenses and profits and all that. That affects your rate too. So if a company needs to make a certain amount of money, they already know they have to make this much, and then they have to charge you a little extra on top of that.
Is that what people call points?
No, it's not points. Points are more or less buying down a rate to get a better rate. This is more or less I'm getting a little into the weeds here, but interest rates are sold to companies at a little different level than they sell to the public, so they can make a little bit off of it.
Okay.
So it's about padding your rate. It's all baked into the rate. Points you can see. Points are going to be charges on your loan estimate that you can see points. The difference what the companies make, you're not going to be able to see that. It's just the only way you're going to know is if you go from one company to another and they're vastly different in what they're charging you. That's the only way you're going to figure that part out.
Okay, and and how is it for a client to figure that out? Does everyone get a good faith estimate on the loan, or how does that? How are they able to compare apples to apples?
Well, your loan estimate will, and your loan estimate has an APR attached to it, so you have your note rate. And this is another thing that confuses people because they made some changes to what APR stands for. It doesn't really mean annual percentage rate of your mortgage anymore. It means APR means the interest rate plus the closing costs amortized over 30 years. Okay. So if you have a 4.5 interest rate that your lender's quoting you and the APR is 4.8, you subtract those two numbers, 4.8 from 4.5, and so 0.3% of your loan over 30 years is the cost of your loan. The government in their infinite wisdom decided this would make it simpler for people to figure it out, but I think it really confuses a lot more people because when they see APR, they'll call and say, well, you told me it was a 4.5. Why is my APR 4.8? I go, no. Your note is a 4.5. That's what you pay every month and every year and all that. Don't worry. That's what you're paying. The 4.8, remember, is the APR with the closing costs. So they try to make things simple, but they made it a little more confusing for people because people get a little thrown off by it. But your APR is your closing costs plus your interest rate.
Okay.
And that's how you can compare one company to another on what they're charging you in fees.
And the good thing is, once you reach out to Eric or any of your loan officers out there, they'll be more than happy to go over those rates for you and break them down and explain them to you so that we can understand them, right?
Absolutely.
So another misconcept that I have is if a client doesn't have credit scores, but their parent has amazing credit or their brother has amazing credit and they want them to co-sign, are they able to do that?
It's not going to work. I get this a lot. Your credit score has to qualify. Everyone on the application has to qualify, not just the person with good credit. I'll have a client. I'll talk. They'll do an application with me. I'll call them and say, "Hey, I'm sorry, your credit's at 550. You need to work on it." They go, "Well, my dad has an 800. How about I just add him on and kind of get the loan that way?" And then I have to explain that to them. So even you and your cosigner have to qualify with your credit. The one thing that a cosigner helps you with is just income. That's all it really is. Mm-hmm. They're just adding more income onto the application so that your debt to income ratio is within guidelines and you will qualify for the loan. And real quick on cosigners, just because your friend has great credit or your uncle or your dad or whatever, and they have a house and a car, doesn't mean they can help you. because they might have too much debt. So we're going to add their debt and their income on top of your debt and your income. And so if you're going to get a co-signer, someone who has good credit, good income, and not a lot of debt is what you're really looking for in a co-signer.
Right. And then, correct me if I'm wrong, but let's say that there's 4 different applicants for this one loan application. And one person has an 800 score, one person has a 700, a 650, and a 642. Your approval is based on the lowest of the 4 people, correct?
Absolutely. We have to have the lowest credit because we have to assume that's the worst, we have to assume the worst case scenarios. So with the person with the lowest score on there, we have to go with that.
Right. Now, one thing about the credit scores I want to educate you on is that there's a misconception out there that you take all 3 scores, divide them by 3, and you look at the average. But it's actually not the average. A loan officer will ignore your lowest credit score. They'll ignore your highest credit score, and it's your mid score, your middle score, that determines an approval or a denial.
Absolutely. And when you buy a car, they're taking your highest score. And so with mortgages, we have to be a little more cautious. So we're going to throw out that high score. And we're also going to throw out the low score because maybe TransUnion is reporting something, or maybe it's just something different going on there. And that score just happens to be a lot lower than the rest. So we'll throw that one out. I've seen it where someone has a 720 score, and then they had a 689 and then a 589. We're not going to hurt you with that 589 because, again, it could be just something with the scoring in that particular credit bureau that's causing it a lot lower. So we'll use the middle one. We'll take the middle road. We'll go with the middle and say, what, that's more of an accurate picture of how they pay their debts.
Oh, another myth I've heard is if someone files a Chapter 7 bankruptcy, that they can't buy a home for 10 years.
Wrong. That's a lie. It's actually 2 years on FHA and 4 years on conventional.
Okay. And how about if someone had a foreclosure?
Foreclosures are 7 years on conventional and 4 years on FHA.
No, so see, there's a lot of hope out there for people who have to file bankruptcy.
And I have programs. As long as you have the money to put down, I have one program. It's called the Second Chance Loan. It's if you have 15%, 15% to put down. It doesn't matter how long ago the short sale was, the foreclosure was, the lates on your mortgages. By the way, if you have more than one mortgage late in a year, you can't get another mortgage. You have to wait. You can only have one in a year. If you have 2 in a year, you have to wait till that one is passed. So I've helped people who were trying to sell their house with this program, but they had a couple of lates because something happened with their business and family and all that, and they got behind. Well, with that program, they were able to sell their house, buy another home, use the 15% down they had in equity on the next house, and then they're going to refinance in about a year as their scores are coming up. Okay. So there's hope for you guys if you've had foreclosures, even recently. You just got to reach out to me.
Yeah. Oh, I know another myth. I hear that once, I purchased a home back in 2008, and I was told I could never be a first-time home buyer. How accurate is that?
As long as you have not owned a home in 3 years, you're a first-time home buyer. That is the definition of a first-time home buyer, is you have not owned a home in 3 years. In fact, if you owned a home and rented it out, so let's say for some reason you left the Bay Area. Well, it's probably because it's too expensive. But you left, let's say wherever area you're at, you left that house and you rented it out. You moved to Fresno or Visalia, and you were renting the entire time. As long as we can prove for the last 3 years you've been renting. So it would be more or less, we're looking for is evidence from a property management company, not your mom saying, yes, he's paid me rent here for the last 3 years. That's not going to fly, okay? So, but what will happen is if you've rented out that property and you rented for yourself, you still are a first-time home buyer. You can get a first-time home buyer down payment assistance loan program.
Wow, that's one I didn't know, so that's awesome.
I ran into that one. It was interesting.
Yeah, wonderful. Okay, well, we'll be back. When we come back, we're going to discuss how much down payment do you really need to purchase a home. And also, there's a lot of millennials who are concerned about the current housing market. So we'll be talking about that too, so stay tuned. Hi, welcome back I'm sorry, I can't speak right now, to Home Buying Tips with Allie, and I'm here with Eric Dahlberg of Gold Standard Mortgage. So Eric, another myth is that I need $50,000 down to buy a home. How does that work?
You don't. You know, I follow Dave Ramsey, and I like a lot of his principles, but to say that you should only put 20% down and get a mortgage is a little unrealistic, especially here in California. Who has $200,000, $300,000 put down on a house, right? So
Some of you do, but not everyone.
not everybody. So not everyone can put 20% down. It's a good idea if you can, because then you avoid mortgage insurance. That's great, but it's not necessary. You can get in for as little as 0% down. There's USDA and some of the smaller rural towns around the valley, as well as down payment assistance programs where they will basically, it's not free money. They're going to put a lien on your house, but you're not required to make any payments right away. That's with the California Housing Finance Authority, and they will loan you money for down payment and closing costs. So you can actually get 3 liens on your property. You're going to have the 30-year fixed mortgage as your first. Then you're going to have the down payment assistance, which is called My Home program. That would be your second, and that would be the 3.5% you would need down for an FHA loan. And then you can get closing cost assistance up to 3%. Now, granted, it's not going to cover all your closing costs, but covers quite a bit of your closing costs. Where a lot of my clients are either making up the difference with their own money, or the sellers are paying the difference for them. My last client got her $1,500 deposit returned to her. So we had the 3 liens plus seller credit, and the deposits she had to put down to make the offer. She ended up getting that back, so she'll have $1,500 in her pocket to go get some new mini blinds. So she's really excited about that.
Or to put in savings for her first mortgage payment.
Or savings, but in this case, this house had no drapes or anything, so she figured window coverings was a must.
Yes.
But as far as down payment, there's a lot of programs out there. Conventionally, even allow you to go to 3% on some programs, depending on the income that you'd have to qualify for. So typically, my clients are dealing with FHA loans where they need 3.5% down, or conventional loans where it's either 3 or 5% down. That's the majority of my clients where they're at. And then I have clients who have the 20% down, or they're selling a home and using the equity from their house to put 20% down, so they have no mortgage insurance. So
Right.
There's a lot of programs out there, folks, I can help you with. If you have very little money and you need help, definitely let me know. I have a great program for you.
So you mentioned mortgage insurance. That seems to be a concern for a lot of people. Can you touch on that?
Yeah, mortgage insurance doesn't pay for your house when it burns down. That's a myth.
Correct.
A lot of my buyers get the two mixed up, homeowners insurance versus mortgage insurance. They sound kind of similar. They kind of, it's about the house, right? I get it. And before I started doing loans, I didn't know the difference either. So I don't blame anyone for not knowing. It's kind of confusing. But the mortgage insurance is to pay the mortgage. It pays the lender. So essentially, because you're not putting 20% down, what you're doing is you're paying for an insurance policy for the lender so that they will lend you the money. Otherwise they're not going to lend you the money. They want to make sure that if for some reason you can't make the house payments anymore, that they're going to get their money back.
Right.
And so your homeowner's insurance is going to be there in case there's a fire or a flood or a break-in or something like that happens to your house.
One thing I learned about mortgage insurance, which I thought was very interesting and very beneficial to clients out there, is if you have mortgage insurance and life happens, you lose your job or you're no longer able to work or something like that, you can actually reach out to your mortgage insurance and explain to them what happened, and they can either defer your payments that you're currently behind on. They could put them at the end of the loan, or let's say that you were unemployed for 3 months, couldn't make your house payment for 3 months. They'll pay them for you, but then once you start working, they'll evaluate your income and divide the payments that they had to pay for you into 12 months and just add it onto your mortgage to get you caught up. So there's actually a benefit to having mortgage insurance on your loan. It helps you.
Yeah, and there's a different mortgage insurance. There's another type of mortgage insurance too that's to protect you in case you can't work.
Right.
And it'll pay your mortgage.
Yeah.
That's a different one. But there's some different things that you guys can look at. I've heard of this type of mortgage insurance for being laid off or being unemployed. to help you out with your house payments. But that's not the mortgage insurance we're talking about that your lender puts on your mortgage payments. There's a different, but mortgage insurance is something that can fall off on an FHA loan.
After how many years?
If you put 10% down, it's 11 years. If you put 10% down in a 15-year mortgage, it'll fall off. On a conventional, it's after about 11 years it'll fall off.
That's good to know, because some people think it's on there forever, which in some cases it is on there for the full 30 years.
If you're making your normal mortgage payment for conventional, it takes about 11 years of basically what they're going to do is they're going to look at your starting balance and your current balance of your mortgage. As soon as your current balance is 78% of your original balance, so that means you've paid 22% down, then they will remove it.
And now, what if your home goes up in value and you get a new appraisal? Will that help them or no?
Every lender's a little different on that. They will allow you to do it, and then some have a little bit of a time period, maybe a year or 2 years after your mortgage, they'll allow you to do it. So that'll depend on your lender. So I would definitely call your lender to see if you can do that. Now, if you've owned a home for 5 years and you have about 40% equity, so you can either ask them to remove it or you can refinance and get a better interest rate and get rid of the mortgage insurance.
Oh, yeah, that's awesome, because I'll save you some money. I know I'm personally paying $167 a month extra just for my mortgage insurance, and it comes off next year. Yes.
And also, just to let you guys know, there's other programs called lender-paid mortgage insurance, where I'm doing this a lot for people right now. They're not putting 20% down, and they're putting 5% down, but because we're charging them a little higher interest rate, but they have no mortgage insurance.
That's nice.
So the savings are it's being offset.
Right.
You're either going to pay it monthly or we just charge it, but you're going to pay a little bit more in your interest, and you're going to save more by doing it that way rather than having the mortgage insurance.
All right. That's a great benefit.
So if you guys have questions about that, feel free to reach out to me. I'd be happy to explain that in further details.
And I know I haven't mentioned this before, but Eric's contact information is actually at the bottom of the screen, so you can reach out to him on his cell phone, and he'll be happy to take those calls. So our last myth for the day
This is probably the biggest myth right now.
is how many millennials are concerned about the housing market and about actually buying. I'm actually hearing that more millennials are opting to rent rather than purchase.
Yeah, we have to think back to when the millennials were growing up, and 10, 15 years ago, more like about 10 years ago, we all know what happened. The housing market crashed. A lot of them saw their parents and their parents' neighbors and parents' friends and their relatives, everybody losing their house.
Yes.
And so when I talk to millennials a lot on the phone and about purchasing, a lot of them are like, well, I'm going to wait till the houses drop. And I'm like, well, it's not going to happen exactly like that. And the reason why is, in order to have a market crash, and in order for anything, like whether it's stocks, gold, oil, whatever investment you're talking about, in order for it to literally fall to nothing, there has to be way more people selling the same thing at the same time. For that to happen, there has to be way more sellers than buyers. Right now, we have way more buyers than sellers. We have way more people wanting to buy a home than sell. People who aren't selling their homes right now don't feel like they have to. They like their home. They like the school district. They don't feel like they need to sell their home. Now, flashback 10 years ago or more, it's 2007, so 12 years ago, literally everyone in a bad mortgage was looking to get out of that mortgage as soon as they could, and they all threw their home on the market. And when the home didn't sell, they dropped and eventually the banks had to take over the homes, and then people were picking these up for pennies on the dollar. I don't think we're going to see that anytime soon, people. If you're going to wait for that, I've had people tell me 5 years ago they were going to wait for the housing prices to drop, and now here we are 5 years later, and home prices have gone up 40%.
Right.
And they could have bought the home, made 40%, sold it, bought another home, put 20% in the bank, put 20% into the mortgage, and been a lot better off. So timing the market, no one really can time the market.
Right.
No matter what, whether it's a stock market, whatever market you're talking about, timing just doesn't work. What I would say is if you feel like you want to own a home, you have the desire to own a home, And that's why you should buy a house. Is you don't wait for the prices to drop $40,000 so that maybe you can flip it in 2 years.
Right.
You know, very people profit off of flipping, and it takes a lot of time, skill,
Effort.
money to flip properties, and the normal person just can't do it. I would say is you find a home, you first off get a budget together. Find out what your budget is. What can you afford on a monthly basis? And if you don't know how to do that, I can help you set up a budget. But you get the budget together. We'll figure out what the mortgage payment that you can afford. Then we'll figure out how much of the house you can buy, and we'll go looking.
Right.
You know, let's figure all that out first. Too many people are just sitting around waiting for a miracle. Like, oh, all of a sudden these homes are gonna be worth $100,000. It's not gonna happen.
Yeah.
So. Home prices are probably going to stay level for a little while. You know, even if we have a recession, I think we'll still be still kind of going up. I don't think we're going to see a huge drop.
No, I don't think so either. We're not having those same negative amortized loans that we had back in 2006, 7, and 8. And I actually was victim of that. I purchased a home in the Bay Area for $710,000, and my payment was $1,300 a month for 3 years. And all of a sudden, the balloon payment came, and my payment began $6,000 a month. So, can you say short sale? Very quickly.
And that's the thing, guys. When I pre-qualify you, you're going to feel like I'm asking for your firstborn child. You know, I get people like, do you need anything else? Yes, we'll probably need more. And, you know, I understand it's frustrating to have to get more and more documents back and all that, but let's just think about the alternative when they really weren't asking for any documents. They had things called stated income, guys, where you would state your income. How crazy that sounds. I don't know how that was allowed, but that's what happened.
Did I tell you I make $1 million a year?
Right?
Can you give me a loan?
Sure. A loan. How much you want, 100 million?
Sure.
You see, so the underwriting standards for the last 8 years have really picked up. Since I've been in the business for the last 6 years, the underwriting standards have been tough, and I just don't see us having a big crash. Now, will we have a correction?
Yes.
Everything corrects. You know, at some points, price is going to go so high, but it doesn't mean that they're going to drop to the floor either. It just means they maybe come down a little bit, and you're going to see this probably more in local markets first, like LA. LA is just ridiculously expensive. So we'll see probably housing prices drop in LA first before we see it in Central Valley. We are the most affordable place to live in California, and everyone wants to live in California. So
Right.
we have people coming here. So home prices in Central Valley are going to probably remain stable. You'll probably hear about stories in LA of prices dropping, but you know when a shack is going for $700,000, I don't know what else you can do. Right?
I agree. I know.
So don't freak out on any news you hear from LA or anything like that, or nationwide, because everywhere is a little different
Right.
when it comes to house prices.
Well, guys, it looks like our time is up. So thank you so much, Eric Dahlberg of Gold Standard Mortgage, to share with us some of your home buying tips and myths. And stay tuned. We'll be back next week, Tuesday at 12 noon. And Eric can be reached at 559-259-5522. And if you need any help with your credit so you can come out and see Eric and purchase a home, you can reach us. Just go to www.ficodiva.com. And we'll be more than happy to assist you with your credit needs. Have a great day. Thank you for watching, and we'll see you next week.
Bye, everybody.
Bye.